For the next hour, you'll be leaving the Show Me state and entering the Show Me the Money state. So stop what you're doing, grab a pen, and get ready to learn. Jake Floyd of Floyd Financial Group will be your guide for straight talk and honest answers about living the life you deserve in retirement. So prepare to be empowered. Now, here are your Show Me the Money hosts, Randy Floyd, Jake Floyd, and Jeff Shade.
Thank you so much. Good morning and welcome to Show Me the Money with Randy and Jake Floyd, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. I'm Jeff Shade. I'm just here to ask the questions, but of course the words of wisdom and solid advice, they do come from Randy and Jake Floyd of Floyd Financial Group. Randy's off this week, so Jake, how are you doing, my friend?
I'm doing great, Jeff. Thanks for asking.
You're certainly welcome. I hope everybody is having a great fall morning. We're glad to be with you each and every week here on 104.1 FM KSGF, where Springfield comes to talk. A lot to talk about on today's show, Jake, so let's dive in right now for our listeners. Jake, has the market priced in a Trump victory, do you think?
Jeff, I think we're starting to see it begin to get priced in. And so the market has been pretty tentative. A lot of the hedge fund managers have endorsed Kamala, have given her campaign money, all this kind of thing. And I think as we're looking at the whole situation, this last week, 2 weeks, when we're starting to look at things like consumer confidence, which was at the second highest reading of the year, there's a lot of different metrics that are really improving a lot, that are measuring different consumer behaviors and consumer outlooks. I think a lot of those are starting to go way positive, much bigger and much higher than all the expectations are. And I think some of that is people are really starting to price in a Trump victory. I think that prior to the last 6 weeks or so, that was not really being priced in. But I think over the last little bit, we're starting to see people be hopeful a little bit again for the future and starting to see things really, really ramp up. And I do think, Jeff, that there's a pretty good runway for us to see a Kamala concession on the 6th of November, which if you'd asked me that 6 months ago, I would have told you there's no way. But right. I do think things are evolving. We're seeing in the polls where the early mail-in voting and things, which is normally very, very blue, is not that blue. In fact, there's a lot of Republican states winning. And I think the stage is set for a pretty big victory, but we'll have to see here in a few days.
Jake, what is it about a Trump victory that has caused the market to be so encouraged, and what can we expect from a Trump victory in terms of us individually and taxes, that sort of thing?
Yeah, I think a lot of people listening to this show, even if they're not Trump fans, are hopeful that we will not end up with a Kamala victory, simply because of what that means for our way of life and our freedoms, and more or less the banning of the First and Second Amendment that she effectively wants to have passed through Congress. She's not saying that directly, but she's calling for censorship of media. She's calling for censorship of speech that she does not agree with. And I think a lot of people realize how dangerous that is. That's a very dangerous thing to do. If we end up with Trump, I think that our way of life, our what it is to be American, will be preserved in a way that it will not if Kamala is elected.
So taxes, though, that is the big thing, I think, from a business standpoint that most people are concerned with. Of course, the 2017 Tax Cut and Jobs Act will expire at the end of 2025. Is that really what people are concerned about? We've gotten used to this. We want it to continue.
Yeah, I think there's a lot of people that are concerned about that. Looking forward, how much you're paying in taxes in retirement is one of the most important factors to your retirement. If we had to pay an extra 20 or 30% in taxes, there's a lot of people that wouldn't be able to make it. I think it's very important. I do think that both parties, if elected, will either keep it the same or lower taxes on people that are under $250,000 a year in income. So I'm not super worried about that aspect of it. I'm more worried about our freedom and that kind of thing. But as we look forward to the other side of this election, I think there's a lot of people wanting to get done talking about this election. I know I'm one of them.
Right.
I'm having election talk fatigue.
Me too.
And who knows? We may be done talking about it next week. But it also may be a couple of months. So we'll have to see how everything goes. I'm hopeful that a lot of this will get put to bed and we'll be able to get back to life and, American prosperity, the American dream that is not dead in this country yet, and hopefully will not be for some time to come.
Yes, of course, Trump is going to be very business friendly, and I think that that is very, very important. You know, for the first time in a long time, major newspapers, two in particular, have not endorsed a presidential candidate. I think it was the Washington Post and the LA Times. What do you make of that?
Yeah, I think Mr. Bezos over there at the Washington Post is a little bit afraid of what may happen if he endorses Kamala and Trump is to win. And I think I'm not saying that Trump is going to exact retribution the way the left media has been saying for the last 6 months or so. But I do think these candidates are a little bit concerned where they were not 6 weeks ago or so that he is going to win. In fact, not just Bezos, but Apple CEO Tim Cook reportedly had called the Trump administration. Trump said he talked to him. He talked to Sundar Pichai, who is the CEO of Google, and other major tech firms that really had not been calling him or taking calls, and now they're kind of opening up and saying, wow, I think these companies are potentially seeing the writing on the wall. Companies like Google have all this data, and they can kind of see things that the average person can't as far as the direction of everything. You know, for example, CNN conducted their final poll, and it showed Trump 47, Kamala 47. Well, in 2020, Biden was plus 12, meaning he was winning by 12 percentage points, and it came down to about 22,000 votes. So if CNN is really showing that they're tied, I would think that would be a huge edge for Trump at this point.
Jake, for people my age, for people of Randy's age, we remember the most trusted man in America was Walter Cronkite. And of course, back in those days, we had the Huntley-Brinkley Report and so forth and so on. We considered that unbiased media. Today, it doesn't seem that there is any unbiased media at all. Every place you turn has some sort of an agenda. Do you think that's true or not?
I do think that's true, Jeff, and I think this not endorsing a candidate could be the first step to a change from that direction, because right now everybody is just pushing as hard as they can whatever narrative or agenda that it is that they want. I mean, for example, at Trump's Madison Square Garden rally, right? During the running of that, MSNBC was covering it, and at the footer at the bottom of the thing it said, Trump holds rally 85 years after pro-Nazi rally in the same arena was held, basically equating him with Hitler and these types of things. I mean, that is so far out of left field and so far out of context and has absolutely nothing to do with Trump. The Democrat National Convention was there 3 times in the last 4 decades too, but that doesn't make them Nazis any more than it makes anybody else Nazis. This unbelievable equating with all these different things that they're just subtly, sometimes not so subtly, but subtly trying to equate Trump with dictatorship and all these things. They're just pushing this narrative trying to help Kamala get in. And I think that people are really starting to understand that that's what's happening for the first time maybe ever. And I think that, you know, Jeff Bezos and then I think it was the Los Angeles Times that also decided to not endorse a candidate. This may be a shift toward hopefully maybe some more unbiased media in the future as, you know, the pendulum swings back and forth, and maybe it's swung as far to the left as it possibly can at this point, and maybe we're seeing gravity start to take effect.
We're talking with Jake Floyd of Floyd Financial Group. Our telephone number 417-889-7233. If you'd like to get in and talk to us about your journey towards a prosperous retirement, again, 417-889-7233. Jake, consumer confidence, second highest this year. That exceeds expectations, does it or does it not?
Absolutely, especially going into an election. Usually you have people start to get worried. You don't have them ramping up ahead of the election unless they see something maybe that everybody else doesn't, which is that they're starting to be more confident about the future. And I think that some of this is maybe unpricing in civil war, right? Where, you know, people were expecting a very highly contested election, and it may still be. I'm not saying it won't be. I'm just simply saying that people are starting to see, myself included, a potential avenue where it's not total chaos after the election. And so if they are right, and the markets typically are right more than the people talking about it, including myself, the market has a way of pricing in reality, which is what I think is so fascinating about some of these crypto betting markets like Polymarket, where they're taking People vote with their money, basically, and they go in and they say, hey, I think Trump's going to win. Hey, I think Kamala's going to win. Last week, the last reading I saw, it was 66% Trump win, 33% Kamala win. It's interesting when people are putting their money on the line. Markets have a way of gravitating toward the correct answer, even when everybody seems to be in disagreement about what it might be.
Jake, talking about the markets, I was looking here, markets year to date, the NASDAQ, S&P 500, Dow, the 10-year. These are all up at this point. Economic data has lately been better than expected.
Yeah, a lot of that is the unraveling of uncertainty from 2022 through 2023 and now into 2024. So while we are into some new territory for sure, it took us till January this year to get to the new territory. So I do think some of that is just momentum from there. Some of it's just earnings. People are like, how can the market keep going up? Well, if earnings keep going up and stock prices are based on what companies earn, it would stand to reason that markets would go up. And so, earnings I think are quite a bit higher than a lot of people expected. And, I don't think that's going to slow down anytime soon, especially if we end up with the correct president and the correct policies moving forward that still incentivize growth, incentivize small business, incentivize hard work. I think that earnings can continue to grow.
Jake, is there anything that you think can stop this train as it is right now?
I think there are lots of things that could stop this train. I would say things that we know of and things that we don't know of. Sometimes simply the unstoppable nature of it. When you're asking questions like that, a lot of times you're at the top. If we're saying, hey, is there anything that can stop this? It's never going to come down again, right? Those are the kinds of things that we were saying in 2000 with the dot-com bubble. I don't personally think we're in a bubble because earnings are backing this up, but I do think that it's been a big run, and if we have some chaos around the election or after, if we have a Taiwanese invasion, if we have more war breakout in the Middle East or whatever, I do think the market could be vulnerable to those things, but the market typically climbs the wall of worry. Meaning, what about everybody's worried about this and that, the things I just mentioned, things I haven't mentioned. The market has a way of just kind of taking it in stride, and maybe it comes down a little bit, and then it goes a little higher the next time, and it climbs that wall of worry. So I think the biggest thing people need to do is not panic if there is turmoil around the election, and think about what you can do to take advantage of that volatility as it comes, because I think that any volatility around the election or after is probably a buying opportunity because the market has a lot of tailwinds looking forward the next 3 to 5 years.
Jake, before we continue our conversation, I want to remind our listeners that if you're hearing the program right now, you're not sure whether you're on the right path for retirement. You're really not sure how the market and the economy is going to affect you and your goal towards a confident retirement. We may have an answer for you. It's called the Floyd Financial Group Retirement Review, and you can get yours at no cost and no obligation by calling 417-889-7233. I know it's the weekend. Go ahead, give that number a call right now, 417-889-7233. All you've got to do is leave your name and telephone number. Ashley will pick that up. She'll call you back during the week and set up that conversation for you. We want you to be better prepared for your retirement future, so you're going to have a better quality of life. So if you're looking to have a casual conversation to help you understand what it takes to have a prosperous and a confident retirement, call that number right now, 417-889-7233. There is absolutely no cost to this, no obligation, no judgment. We'll meet you where you are. So make that call today, 417-889-7233. You can also find out more about our firm online at floydfinancialgroup.com. Jake, it's time for a break. When we come back here on Show Me the Money, we'll be talking further about home sales, also drilling for oil, Elon Musk. Later on in the program, whether or not you should pay off your mortgage or invest it, and 401ks to IRAs. What should you do? Well, we'll answer those questions when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
Ready for another helping of some more real money talk? Thought so. Now, here's another serving of Show Me the Money with your hosts, Jake Floyd and Jeff Shea.
Welcome back to Show Me the Money. I'm Jake Floyd, and in this segment, we're going to talk about interest rates, 30-year mortgages at 7%, and existing home sales dropping.
And Jake, whether or not you own a home, you're looking to refinance, or you're looking to buy a home, I think everybody keeps an eye on what mortgage rates are. I'm surprised to see, Jake, that they're rising. They're right about 7% now.
Yeah, so prior to the rate cut, we saw the market really bring interest rates down before the rates even got cut. Once the cut happened, then interest rates started to move back up, and people think that's kind of counterintuitive. But a lot of it has to do with the overall bond market. So the Fed has rate cuts as a tool, but those tools have, as Jerome Powell is very famous for saying, long and variable lags, meaning we make changes and it may take months, if not years, to feel the effect of all those changes long term in the housing market and rent markets and CD rates and all that kind of thing. And so the market is always trying to price in where it thinks interest rates are going. And prior to that 50 basis point cut, we were pricing in being at basically 3% interest rates in the middle of next year. And so that's a pretty aggressive cutting cycle from 5.25%. And now if we look at those same rates and what's being priced in to the middle of next year, we're looking at 3.5 in July of next year. And so interest rates moving up are a factor of expectations of where interest rates are going. Also, some of the things we're going to talk about here in a second, how much money we're spending as a country. If we're flooding the market with bonds, anytime we spend money we don't have, we have to borrow that money. We borrow that money by issuing treasuries. As we issue those treasuries find their way onto the market. And if there's too many of those on the market, what has to happen is the yield will start to go up from lack of demand. And so as we're thinking about this whole situation, it's important to understand that what the Fed is doing is important, but so is all this atrocious amount of spending that we're doing in this country, which is why I think Elon Musk, for example, is looking at being the head of government efficiency under a Trump administration. He was talking about last weekend that he thought that he could trim $2 trillion a year out of the budget. That would be a humongous number. I think the total government spending, including Medicare and Social Security and things like that, is about $6.75 trillion. And he thinks he can cut that by $2 trillion. That would be massive. And so that would cause us to issue less treasuries, which would help the bond market and push interest rates down. But also, I do think the Fed is going to keep cutting rates. So we're just seeing normal fluctuation of interest rates in a cutting cycle, especially as we start cutting. The anticipation of that cut comes in beforehand. And then, it's never as good as you think it's going to be. And so after the cut, we see the market start to go, hey, maybe this cut isn't going to fix every problem we have, and so the interest rates go back the other way. The reason I bring all this up and how it relates to people is 30-year mortgage rates are 7% again now. In order to bring that rate down and bring real interest rates down, drilling for oil is kind of the key to that, in my opinion. And I think that's the reason why Trump is so focused on talking about oil. Is if we bring the price of oil from $70 a barrel down to, let's say, even $40 a barrel, which I think it could go even lower if he really opens the floodgates on oil. Let's say it's $40 a barrel, and let's say the price of diesel goes from $4 a gallon around here to $2.50 a gallon. Mm-hmm. That means the price of everything you're shipping, is going down 30, maybe even 40%. Because the main cost that you pay in there is your oil cost, right? Into the diesel fuel and all that. And so as that unfolds, that will cause price deflation for a period in this country where we've had disinflation to this point where the rate of inflation is coming down. But deflation is where the prices actually come down. And when that starts to happen, then interest rates will really start to come down because the Fed will bring them down, number one. But overall, that just is a huge deflationary pressure. And so if we can get the inflation under control, that will help get interest rates under control, which will help get housing mortgage rates under control, which will help get everybody's debt, their unsecured credit card debt at 30% interest under control, get their student loan debts at 11% interest under control. And all that trickles down to everybody being in a better place financially, being able to spend more money, which translates into profits for corporations, which translates into higher stock prices, which translates into happy retirements.
And I think that really there has to be a change in people's thinking, too, that just because you have a credit card doesn't mean that you should go out and buy everything right now. I think human behavior is one of those things that is rather difficult to change, but we're going to give it a try. So I've always thought when rates go up, mortgage rates go up, that your property values are less. And when, mortgage rates go down, your property values are more. And I'm seeing that property values really have not really changed that much. So with that in mind, how important is the housing market, and why should we consider that when we're planning for our retirement?
I think the housing market is a bigger deal than people understand. And the housing market being totally seized up the way it is right now. So again, we had a 15-year low in existing home sales last month. And I think the reason that's important is if interest rates are high, people can't refinance their loans, right? If they can't refinance their loans, they can't pay off all that credit card debt that they racked up, which means then they can't spend money, they can't afford their groceries. And to your point, Jeff, while I'm not advocating people racking up debt, people are going to rack up debt anyway, right? And unless they physically can't, because there's no more debt to incur. They have no more room to do that. Then you start to run into a crisis situation where people can't afford their groceries, they're drowning in the debt that they already have. And for the last 25, 30 years, their solution has always been, well, let's refinance the house, let's crack the piggy bank open, and let's pay this stuff off, and then we can go again. And so getting interest rates down to facilitate people not drowning in credit card interest it's hard to overstate the importance of that. And I think that if you look at like Kamala's plan or lack thereof, it fails to address the problem with interest rates, the problem with people drowning in credit card debt, the fact that people want to move and can't. Her solution is just to give them money, give them other people's money, and that's not going to fix the situation either. In fact, that's just going to create massive inflation if you start just doling out $25,000 to first-time home buyers and things like that. It's the wrong direction. We have to grow our way out of this problem. We have to be able to maybe cut some spending, true, but we need to grow things in a way where we're growing the economy to generate more revenue, because we're not going to be able to cut enough spending to get to balance this budget. We're going to have to grow and cut. And I think that's possible under the right leadership and with the right incentives and people that understand that small business is the backbone of America. And so I do think that's possible, but we do need the right leadership to make that happen.
Jake, I have the ability to rack up humongous amounts of debt, but my utilization, the amount of credit that I'm using versus what's available to me is under 1%. So I guess I'm just a little bit weird because I am in that retirement age, but I think going into retirement, you should have no debt except for maybe your mortgage. What do you think about that? Is there good debt and is there bad debt?
Yes, I do think there is. Certainly unsecured debt at 30% interest qualifies as bad debt. I do think that if you're sitting on a 3% mortgage, it's really hard to want to pay that off. And that's what we're going to talk about in the next segment here, so I don't want to jump too far ahead. But I do think there's good debt and bad debt. Student loan debt has kind of become bad debt, where it used to be a little bit better debt simply because the interest rate was lower. But now there's a lot of people paying 10, 11% interest on their student loans, and their minimum payments are $1,200 a month and stuff like that. I think that student debt has jumped over the barrier from good to bad debt, I guess. Yeah, I would say that probably most things other than the mortgage are bad debt in today's world. If we get back to a sense of normalcy on interest rates and you can get 0% interest on your truck debt or something like that, that's fine. But short of that, I think mortgage debt is okay, especially if you're itemizing, because you get to deduct that up to $750,000 worth of home value. I think the rest of it, though, you really want to, especially from a retirement standpoint, we really want to get a lot of that debt dealt with before you pull the trigger on retirement.
Talk with Jake Floyd at Floyd Financial Group, and of course we're offering you the opportunity to sit down with Jake and Randy at Floyd Financial Group. 417-889-7233 is our telephone number. Call it right now and request your Floyd Financial Group retirement review. Jake, before we end up this segment, I do want to revisit something that you talked about. That's Elon Musk and his efficiency position there, possibly saving $2 trillion. That is a lot of money, Jake. Where is he going to find $2 trillion to cut?
I think that shows you how much waste there is in the system. I don't think Elon would have thrown that number out there unless he had looked at where that spending is occurring and where he could cut it from. When he bought Twitter and turned it into X, he fired 80% of the employees right off the bat. And then he has done, in my opinion, and you'd have to ask him how much more work there is, but he's done 10 times as much, in my opinion, with 20% of the people. And I think that the government specifically has a way of incurring and putting on weight, if you will, of dead weight of government agencies we don't need, departments we don't need, people that are not working as hard, right? It's hard to get fired from a government job. And so there's people that just don't work, right? But they still get their paycheck. And so I think if you go in, you really look at what's necessary and what's not necessary. I think half these 3-letter government agencies you don't need at all. I think government has a way of getting bigger and bigger and bigger and never getting smaller. We're seeing this in Argentina with Javier Milei. He went in there, and in 9 weeks, he balanced the budget for the first time in like 100 years.
Wow.
He got rid of 60% of all government agencies in the first, I think it was 9 weeks. Don't quote me on that, but I'm pretty sure that's right. And so that's what we need to do. We need to downsize here. The Department of Education, right? It sounds really great, but all they do is peddle wokeness to kids. That's their whole purpose in life. And there's a lot of this stuff that we just simply don't need. And I don't know if $2 trillion is realistic. Elon has a history of being optimistic, but I think even $1 trillion would be a huge step in the right direction. And that's just that much less weight that we have to carry. And I do think $1 trillion is definitely doable.
Well, Jake, I think based on our conversation, our listeners certainly may have some questions of you. If that is you, again, give us a call. You can do it right now this weekend, 417-889-7233, and request your Floyd Financial Group retirement review. No cost, no obligation, no judgment. We'll meet you where you are, totally complimentary. Make that call right now. Ashley will call you back during the week. All you got to do is leave your name and telephone number. It is that simple. It'll take you about 60 seconds to do it, and it could be the best call that you'll make all year. 417-889-7233 is our number. Check us out online, if you will, FloydFinancialGroup.com. Time for a break, Jake. When we come back, we're going to be talking about paying off your mortgage or investing that money. Which should you do? All that and more when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
We're back with your financial catch of the day, and it's a big one. Here's more Show Me the Money Radio with your hosts, Jake Floyd and Jeff Shane.
Welcome back to Show Me the Money. I'm Jake Floyd, and in this segment, we're going to be talking about, should I pay off my mortgage or should I invest that money instead?
And Jake, that is a common question that we get, and I've discussed this with friends of mine many, many times. I've got the money to pay off the mortgage, but I don't know whether I should do that or not, or whether I should take that money and invest it, which is going to be better. So let's explore this a little bit here in depth. When is it better to pay off your mortgage early?
Yeah, so there's several different reasons that it might be better to pay off your mortgage early. The first one is the most obvious one, which is, if you want to quit paying interest on your mortgage, right? And especially in today's world where 30-year mortgages are being issued at 7 and 7.25% interest, that's a lot of interest. Now, as we look at that as it relates to 2.5 years ago, when interest rates, you could get a 2.5% 30-year mortgage. That's a big thing we have to look at is, how much is that interest exactly?
And if I've got a 3% mortgage, Jake, and a lot of people did refinance when mortgage rates are so low. I've got to figure the way that I'm thinking about this is, okay, I've got this $200,000 here. I could pay off this 3% mortgage, or I could invest it in the market or invest it someplace else and more likely make more than 3%. Is that a valid thought process?
It can be. You need to make sure that you understand the totality of your overall plan, how close to retirement you are, whether you've secured the funds that you need to produce the income in retirement that you're going to need. It's a very different answer if you're 40 years old versus 60 years old. But I do think in general, if you're paying a lot of interest, it may make sense to pay it off. If you are paying very little in interest, like you said, at 3%, it's very rare to find a time frame where the stock market does not outperform 3% by quite a lot. On average, over the last 60 years, the market's up about 10% a year. And so even if you can capture 60, 70% of that, that's more than the 3% interest.
So if you want to save on interest, Jake, what is the next reason that it would be better off to pay off your mortgage early?
So one of the reasons long-standing, especially since the 80s when interest rates were really high, that people had mortgages and were not in a hurry to pay them off is they were tax deductible. The interest on your home, on your mortgage, is tax deductible. However, in today's world where you have a very high standard deduction, there's many people that do not pay enough interest on their mortgage to justify itemizing their taxes. So they just take the standard deduction, and that home interest is really not a factor for many people. If you own a business or something like that, or you have other expenditures that might warrant you itemizing your deductions, then that could potentially make sense. But for many people, that tax benefit is not really a benefit. So paying off a mortgage wouldn't really take that benefit away from you.
Okay, so we're talking about whether or not it's better to pay off your mortgage early or not. Next one is freeing up cash. A lot of people want to do that.
Yeah, so if you want to have better cash flow month to month, I would say this is probably the biggest reason people do pay off their mortgage is, if you simply have $1,000 or less a month going out, that's $1,000 less a month that you need to make in retirement or just in general life. So that cash flow aspect of it is probably the biggest and best reason to pay off your mortgage, especially if you're looking at taking a significant pay cut going into retirement. Getting rid of some of those bills, namely the principal and interest payment on your mortgage, can be the difference between you retiring and not.
So reducing cash flow out is a big reason why you may want to pay off your mortgage if you can, because you don't know if you're going to be able to afford that mortgage going into retirement. We hope that you will, and if you join us here at Floyd Financial Group, more than likely we're going to find a way for you to continue to afford that mortgage. What about the interest rate on that mortgage? How does that play into things?
Yeah, so definitely if we have a 7% mortgage rate or something like that, that really steps up the reason maybe to pay it off versus invest it. Not too long ago, had 8.5% 30-year mortgages at the end of 2022. And so I think that 7% is better, but we have a lot further to go. If we get that number back down into the 4% range, I think it's more compelling than to maybe not pay off that mortgage, at least not accelerate paying off that mortgage. And, invest that money. That gives you a little bit more freedom, too, if you have a chunk of cash over there. If you're business-minded, that allows you to be able to invest or buy a business or run a business yourself or a million different things. Maybe you have a daughter that's getting ready to have a wedding and you need $50,000 to help with that. It seems like that number is, I think the average cost of a wedding now in the U.S. is north of $40,000.
Oh, yeah.
An absolutely insane number to me. So that was a little bit of a joke there, but maybe not a joke for somebody listening, right?
Yeah.
And, whatever that money may be for, you can invest it. And as long as you're making as much as you're paying interest-wise, you're at least not losing ground, but you have the added liquidity of that money. You have that money at your fingertips versus it being stuffed in your house and you having to get a loan to get it out.
And Jake, I've heard people say, well, I want to sleep soundly at night because I own my home and nobody can take it from me. But that's not exactly the truth. Even if you do own your home, people can take it from you if you don't do certain things.
Right. And I think most people, because I actually hear that quite a bit. They say, well, if I pay my house off, then people can't take it from me. I mean, eminent domain, for example, where the government basically takes over your stuff and pays you what they think is a fair amount for it, that can definitely happen regardless of whether you own the house outright. I think people are worried about the bank foreclosing on them or something. Again, as long as you're making your payments, I don't foresee a situation where the bank is going to come and take your house out from under you. If we're worried about Armageddon, then that's a whole nother set of issues. And I do think there are people worried about that. And I think there's a very small runway for that. But I think we're going to get through this election and get through this time like we've gotten through many times before. I dare to be optimistic. And, that doesn't mean I'm blind to the issues that are going on. It just means that I still believe in our country. I believe in what America stands for. I believe in our flag. I believe in the heroes that died for our freedom, and I am not going to give up on them so easily.
Well, I echo your sentiments completely there, Jake, but let's continue to talk about whether or not you should pay off your mortgage or not. There are things called creditors and predators. Now, beyond not paying your property taxes, that is one way that you'll get your home taken away from you. But if you own your home, are you more susceptible to creditors and predators than if you don't own your home? What I mean by that is, can people take your home from you even if you still have a mortgage on it?
Yeah, I mean, creditors and predators, to your point. Yeah, there's really none of that is more susceptible or less susceptible based on whether or not you own your house outright or whether you have a loan on it. So I would say that one is largely false, just meaning if that's what you're worried about, somebody taking it from you, I don't think paying it off really fixes that. The only situation where it might fix that is if you're worried about losing your job and your ability to pay for it. And if you already have it paid for, then you're good. That's the only situation I can think of where that might hold some water. There's a lot of ways, though, to pay off the mortgage, too. You know, if you're over 62, you can do a reverse mortgage to get rid of that payment. That's something that I don't advise a lot of people do, but if it's the difference in you getting retired or not getting retired and you need to retire, it can be a way to eliminate your house payment. Again, there's a lot of detail there that we should discuss, and we can do that when you come in for your consultation. But I think paying off the mortgage or not paying off the mortgage is definitely one of those big questions. And I think the more valid reasons to pay it off are, you know, saving on interest and freeing up cash flow. I think those are the two big ones.
And also, if you're simply debt averse like I am, even though debt, when used smartly, can be a wealth building tool, some people just don't like the risk and liability that comes with it. So being debt-free is among your financial goals, and paying off your mortgage is a very logical step to achieve that. So, Jake, on the flip side of the coin, when is it better to invest instead?
Yeah, so some people, if they have not saved enough for retirement, taking your retirement money and paying off your house is probably not the right idea, especially if it's coming from qualified money, 401k money, IRA money, where there's going to be a huge tax burden to boot. In that scenario, that's probably not the best reason to pay it off, and maybe you should invest that money instead.
So if you haven't saved enough for retirement or put a premium on investing, maybe it's better to invest instead. What's the next one, Jake?
Another one is if you only plan to own your home short term and you're thinking about moving anyway, that might be a reason to not just force paying it off early if you're just going to be redoing another mortgage into a new house in the short term.
Okay, when is it better to invest instead? And finally, Jake, if you have a higher tolerance for risk, can you expand on that?
Yeah, if you have a higher risk tolerance and you're willing to invest money at a higher risk, hoping for a higher rate of return, even if you have, let's say, a 5 or 6% mortgage, it's possible to make more money than that in the market. Certainly not a guarantee, but if you have a higher risk tolerance and you want to roll the dice there, the case could be made for investing rather than paying off the mortgage.
Talking with Jake Floyd at Floyd Financial Group, our topic has been whether it's better to pay off your mortgage or invest it. If you have that question, you're not sure which direction to take, again, we invite you to give us a call here at Floyd Financial Group and sit down with Randy and Jake to talk about your journey towards retirement. It is just a casual conversation. As Randy says, it's a no-tie zone here at Floyd Financial Group. We'll meet you where you are. No cost and no obligation for this consultation. It's called the Floyd Financial Group Retirement Review. You can get yours right now by calling 417-889-7233. Make that call this weekend. It'll take you about 60 seconds to do it. Ashley will call you back during the week and set up that time for you. So many people say, I don't have anyone to talk about my finances with. Well, that has all changed right now with Floyd Financial Group. We are a fiduciary, and we are held to the fiduciary standard. That means that we put your interest ahead of ours always. So if you want your questions answered, you want a friend in the financial services business who will give you the straight talk and honest answers, call Floyd Financial Group at 417-889-7233. You can also find out more about us online at floydfinancialgroup.com. Jake, time for a break. When we come back here on Show Me the Money, we'll talk about converting a 401k into an IRA and more when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
People of the Ozarks, step away from the fishing pole and prepare to be shown the money, because we're back with more straight talk and honest answers with Jake Floyd and Jeff Shea.
Welcome back to Show Me the Money. I'm Jake Floyd. In this last segment, we're going to talk about should you move your 401k, 403b, 457 TSP plan into an IRA once you have retired.
And Jake, so many people that we see here at Floyd Financial Group have 401ks. It's a great investment tool during your working years. But then there comes a time when you switch jobs or you're at the end of your career, you've got to make a decision. Should I switch my 401k into an IRA? So let's start there first of all. The 401k versus the IRA, what are the biggest differences do you think that we should consider between those two things?
The biggest plus about having a 401k, 403b type setup is that you can take an advantaged loan against that if you need to have money out of your retirement account. So you don't actually take it out. You're not paying the taxes. You're not paying a 10% penalty if you're below 59.5. But you can take a loan out of half the balance or up to $50,000, whichever is less. And once you take that loan, when you pay the interest back, you pay it back into your account. So you're borrowing the money from yourself and you're paying that interest to yourself. That is, in my opinion, probably the biggest reason to not roll it out to an IRA after you are 59.5. That being said, if you have severed or terminated employment, you can no longer do that. And so once you have retired, it almost always makes sense to roll it out because of the next reason, which is you have more investment options. Inside of a 401k, you're usually limited to whatever set of mutual funds the people who set the plan up have determined that you can use. Sometimes that's like 10 mutual funds, sometimes it's 100 mutual funds. But since there are 60,000 mutual funds and thousands of ETFs and tens of thousands of stocks globally, it's a very little percentage of what you can invest in out there if you are unconstrained by that 401k setup.
So the 401k has limited investment options, as you said. I mean, I remember when I had a 401k working, there weren't a lot of options there, and I didn't understand the options that they had, and there was nobody to explain them to me. That is a good topic to talk about as well, too. But let's continue our conversation here about the investment options that an IRA may offer. As you said, there are thousands of those. What are some of the options that people should really consider taking advantage of when they're opening up an IRA or at least transferring a 401k into an IRA?
Yeah, so about 60% of all the money in qualified plans is invested into life cycle funds. So a life cycle fund is like a target date fund where it says, hey, I'm going to retire in 2040. So you might be in the TIAA CREF 2040 life cycle fund. And what that means is it's aggressive early on, but as you get closer to 2040, the fund gets less and less aggressive until finally it's very not aggressive, and then it stays that way for the remainder of the time the fund is open. It's a very dumbed down way to invest money, and it's not inherently broken, although it does have a lot of added fees in most cases because inside that mutual fund is a bunch of that company's other mutual funds, and usually both layers have fees. There are some exceptions to that. Fidelity's funds don't do that. Some of the Vanguard funds are very limited on how many fees they charge on the wrapper, but there are some of these funds that charge 0.6, 0.7% for the wrapper and 0.6, 0.7% for the underlying, and you're paying a lot more in fees than maybe you should be. And so taking that money out to the IRA, the world is then your oyster. Either with a financial planner or doing it on your own, you can invest in kind of whatever it is that you want to invest in. And so that may be overwhelming for some people, and if it is, hire a financial professional to help you out. But some people, like the idea, and they're familiar with the stock market and like the idea of being able to choose their own investments. And if that's you, then, rolling that money out of there where you have more control and more transparency might be the right idea.
Should you move your 401k to an IRA once you hit 59.5? That's what we're talking about with Jake Floyd here at Floyd Financial Group. So reason number one, more investment options. Jake, what will be the next reason?
Yeah, if you plan to convert to a Roth, most plans will not allow for that inside the 401k. And so that could be a reason if you roll out to a traditional IRA, then you can convert to a Roth over time or all at once if you want to. Whether or not that makes sense remains to be seen, and that's a calculation that has to be done. It's usually not a good idea to convert to a Roth at really high tax rates because your chances of being in a higher tax bracket once you're retired than when you're working is not very high, but there are situations where that can make sense, and if converting to a Roth is important to you, that could be another reason.
And Jake, do you think taxes are going to go up or go down in the near future?
Well, considering that taxes are already at pretty much the lowest rate since we've had taxes, I honestly, Jeff, I really think they're going to stay about where they're at for the majority of people.
Really?
It may look different, meaning they may change the brackets, they may increase or decrease the standard deduction, but I think the actual amount of tax that people pay if you make $200,000 a year or less is probably going to remain pretty close to where it is. I think if you make more than $400,000 or $500,000 a year, I think it's very likely those people's taxes will go up, maybe considerably depending on who gets elected and that kind of thing. But I think that the average person probably doesn't need to worry too much about taxes going up. And the reason for that is the economics of it. Even somebody who wants to increase taxes to pay for the deficit and things like that, if you increase the taxes on lower income people, you actually generate less tax revenue over time. If you look at the models of how that works, it doesn't make sense to increase taxes on those people because then they can't afford to spend money, which doesn't generate more tax revenue at different levels. And so if you tax the mega wealthy who are not spending the money, especially if you tax their wealth, the case could be made potentially, and again, I'm not for this, but you could make the case that that tax revenue might actually increase net, year over year if you do that. But if you do it on the lower income earners, it really doesn't solve anything. It only hurts you.
So moving your money from a 401k into an IRA, number 2, opportunity for Roth conversion, which does, of course, equate to taxes. What is number 3?
And number 3 is if you want to hire a financial advisor, many times you'll have to roll that money out of your 401k into an IRA to have someone else manage it for you. There are a few exceptions to that, but by and large, that money manager, myself included, would want to be unconstrained by what investment options you have inside that 401k. Now, if you're prior to 59 and a half, if you're still working at the employer, for the most part, you're not going to be able to roll it. But after 59 and a half, 99% of plans or so will allow you to do what's called an in-service distribution and roll that money out of the plan, even if you're still working there after you're 59 and a half. And so I'd kind of like to wrap this whole thing up, Jeff, and just say this. The question is, should you move to an IRA after 59 and a half? And the answer is yes, unless you're still working and you might need a loan. And again, there's exceptions to everything, but I'd say that's the takeaway people should have is if you're going to need some of this money while you're still working and you might need to take a loan on it for some life circumstance, maybe you need to buy a car, a down payment on a house, whatever it may be, then maybe you leave it there. But if you're over 59 and a half and you're still working and you don't anticipate needing that money prior to retirement, or maybe you even want to try to keep it at arm's length so you don't spend it, rolling out to an IRA has a lot of benefits, and I hope that's what we've kind of showcased here today.
That's right, Jake, and a lot of people have 401ks. They retire from a job, but they leave their 401k where it is. They don't touch it. When is that a good idea, or is it ever a good idea to do that?
I think that if you have a very high risk tolerance, and let's say you have a TSP, for example, TSPs are notoriously low in fees. They're also notoriously low in investment options because you have basically 5 funds to use across the entire TSP account. But if you're just going to leave it there in a high risk format for 20 years, let's say you move jobs from a TSP at 30 and you got 25, 30 years to retirement, you could make the case that the low cost option of the TSP and the hands-off nature of it, you might be able to make that case. But I'd say very likely if you've left a job, it's going to make more sense for you to roll it out of there. You're going to get more attention. You're going to have more specificity in what you can invest in. You're going to have better customer service and ultimately have somebody to help you when the crap is hitting the proverbial fan, help you stay invested, help you take advantage of those situations when things are not going perfectly, and help you stay invested so that you're better off on the long haul.
Jake, in the 17, 18 years that you've been working with your father there at Floyd Financial Group, have you seen that is the biggest asset that most people have when they come to you? They make that transition from working to retirement. Is the 401k?
Yep. Real estate and 401k are really the 2 big assets that people have in this area. It's not uncommon at all for me to have people come in with $600,000, $700,000, $800,000 in a 401k and have very little outside of it, maybe $10,000 saved otherwise, and that's what they got. And that's very normal for me to see here. It is important that you get it right with the 401k if you take that approach, because that is your only your only hope, I guess, if you're setting things up where it's all in the retirement plan. Again, there's nothing wrong with that, but it is important to make sure you understand your options once you're 59 and a half. Understand your options on, again, potentially loaning against that money, and then also finally getting that money converted to where you can get income off of it in retirement.
Yeah, and I think that's one of the biggest things that people really want to know how to do is how to turn that 401k into a paycheck. And if I'm hearing you correctly, Jake, what you're saying is that if you convert that 401k to an IRA, you certainly have a lot more options to turn that retirement income into a paycheck. Wrong or right?
Absolutely, Jeff. I think that's probably the biggest takeaway from this.
All right, we're talking with Jake Floyd of Floyd Financial Group, and we're talking about moving your 401k into an IRA. Jake, before we end up our program today, I want to touch just a little bit on this Floyd Financial Group retirement review that we offer here. Can you just tell us in just briefly what that consists of? When people call 417-889-7233, Ashley sets them up with an appointment to sit down and talk with you or Randy. What can they expect?
Yeah, so in that first appointment, the biggest thing we're going to do is want to get to know each other. I need to understand what's important to you, where things are headed for you, how far out from retirement you are, or maybe you're already retired. Just need to understand what's important to you, what you want to have happen with your money, and we really just get to know each other. And you may find me to be reprehensible. Who knows, right? And so you get in there, and
I doubt
this Jake
that.
guy, I don't know about him. And if that's the case, that's okay, because this is very informal, very casual. We're just going to talk about things. And then once I kind of have an understanding of your situation, then usually in a second meeting down the road, we would have another meeting where I would maybe put together some recommendations for you. At that meeting, I'm just going to kind of give you an idea of what the plan would look like. I'm not going to ask you to make any decisions at that second meeting. You can leave your checkbook at home.
Right.
There's no reason to be intimidated by this process at all. In fact, I will probably never ask you to do business with me. I will just wait until it either makes sense or it doesn't make sense. And, once you kind of understand how I would build the plan, that either works for you or it doesn't. And if it doesn't, that's okay. I have a new friend and I'm fine with that. We're fortunate enough to be at the point in our business where I don't need to bring on a lot of new clients. We just want to bring on ones where it's mutually beneficial.
And again, if you're listening to the program today, that is what you want. Someone who's willing to sit down and listen to you and design a plan based on your retirement goals. Call us here at Floyd Financial Group. We'd love to help you out. 417-889-7233. And as Jake said, there's no cost and there is no obligation. Most importantly, there is no judgment. We will meet you where you are. 417-889-7233. You can also find out more about us online at FloydFinancialGroup.com. Jake's been a great show. I thank you for your time, but most importantly, I want to thank the greatest listeners in the world, ours, here in the greater Springfield area. So for Jake Floyd, I'm Jeff Shade. Have yourself a great weekend. We'll talk to you again next week with another edition of Show Me the Money right here on 104.1 FM KSGF, where Springfield comes to talk.
The information provided in the preceding program is for educational purposes only and are not intended as investment advice for any individual or entity. All information contained herein believed to be from reliable sources. However, we make no representations as to its completeness or accuracy. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Financial planning offered through Floyd Financial Group, LLC, an investment advisor registered in the state of Missouri.